information. Apple did work with DeepSeek and have these conversations, but they just felt there wasn't enough manpower and experience to roll out AI at scale. So that's that part of the story, according to the information. Market reaction as well, we're getting that. We saw the ADRs, for instance, rising on Wall Street overnight. We'll track, of course, how it opens in Hong Kong later this morning. But analysts are generally positive, not just from the perspective of Apple. This can help them in that key Chinese market where they're losing market share, but also, of course, for Alibaba to access higher paying users as well.
All right, Annabelle Drill is there. The property crisis, meanwhile, that's hobbled China's economy and created a near $160 billion pile of distressed debt is getting worse. Risks continue to grow as Chinese authorities are forced into the first mainland rescue, and major Hong Kong developer New World's bonds sink into distress. Let's bring in Bloomberg's executive editor for Greater China, John Liu, for more on today's Big Take. John, this issue has been festering for years now. Are we continuing to see signs of contagion, and can it be contained?
Well, we actually saw a bit of recovery at the end of last year. You'll remember all of these stimulus measures that were announced just before the October holiday. We had lots of restrictions on home buying removed. We had mortgage rates lowered. And so there was a pickup in home sales. But that, it seems like, is starting to stumble. The latest numbers that we got for January show that, again, home sales were falling. And that is not helping Vanke's situation. They have about 5 billion yuan of debt of bonds they need to repay this month. They have about 35 billion yuan they need to repay the rest of the year. And if they're not able to sell homes, the question becomes, where are they going to get the money to pay off that debt?
How did we get here? Because, as you said, we had seen signs of recovery. We had seen Beijing trying to put in place more supportive property measures. But at the same time, just these big developers like Vanke now that were once a symbol of strength in this sector are faltering.
I mean, the fundamental issue here is people are not buying homes at the rate that they were buying them in 2018, 2019, and earlier. The issue here is these developers borrowed lots of money on the assumption that they would be able to build these homes and sell them. That is not coming true. We've had prices falling for the better part of 3 years, and in a market where prices are falling, people are going to be hesitant about putting their money into a new home. We've also had protests where people paid for a new home, the developer went under or wasn't able to finance the construction of that home, and there was this danger that people were going to just lose all their money and never get that home. And so all of these stories, all of these issues have put a lot of pessimism in the market, and people are staying on the sidelines.
John, you mentioned efforts from regulators earlier. I just want to look at one of the comments from the story. Co-founder of Forest Capital Hong Kong says China's regulatory efforts are like applying a Band-Aid to a knife wound, and they always come at the worst moment. There's some more proactive action required here.
I think it's really important to note when we're discussing the difference between Evergrande, for example, and Vanke, and that important difference, I think, is the background, the context. The economy today is in a much weaker position than it was when Evergrande was starting to go through its problems. There's a lot more concern in Beijing about the outlook, and we have this threat of tariffs from the United States under this new Trump administration. So all that added together, I think the level of concern when it comes to Vanke is much higher. And I think as a result, the government has shown it is willing to take bigger steps to do more in terms of policy, to do more in terms of helping to try and stabilize the situation.
All right, Bloomberg's executive editor for the Greater China region, John Liu, there on China's ongoing property crisis. We have more ahead on the Asia trade. This is Bloomberg.
our base case, we remain quite comfortable of the view that the Fed will keep policy rates on hold through the course of this year until the middle part of 2026. We do see balanced risks around that, though. Certainly, if we saw fewer tariffs being announced from the US administration, then perhaps then they could move towards rate cuts. But equally, if the economy moves away from that softer landing and we see continued strong labour market data, then we do think that the risks of rate hikes certainly could rise. But in terms of markets, we do think medium term that the dollar can continue to strengthen as we see further delivery and implementation of tariff policies from the US. And with the Fed keeping rates on hold and other central banks moving to cut, we think widening rate differentials will also be a support for the dollar.
So who are the most vulnerable, especially across Asian markets, when it comes to dollar strength?
So I think, firstly, it's a question of rate differentials and where do we see those rate cuts. And we do think that there will be kind of 2 to 3 rate cuts, broadly speaking, across the Asian central banks. But I think the second and more important factor for that China will see further tariffs. But also we see that Taiwan, South Korea, Thailand will be some of the more particularly vulnerable currencies if we do see tariff policies, whether that's on them directly or just indirectly, given their sensitivity to the renminbi.
Well, if we take a look at just China, you mentioned the renminbi there, the yuan, very weak at the moment. How far do you think policymakers will be willing to let it continue weaken? Where's the floor?
So we think that the move in dollar China can rise towards around 745, 750 over the course of this year. And that's if we do see our base case, which is for a further 15 percentage points of increase of tariffs on China. But ultimately, we do think that they will wait and keep the fixing on hold until we see the implementation of them. So we may have to wait a little bit longer before we see that move, but ultimately, we do think that the path is higher. That being said, that's not a very aggressive move in all circumstances. And the reason is ultimately, if we look at the renminbi on a real something that could potentially weigh on risky assets more broadly and consequently then for Aussie as well. That being said, we do think that Aussie could perform slightly better than some of the other higher beta peers because we don't think that the impact of tariffs will be as severe for Australia. We did some analysis and we found that actually a lot of the raw materials that Australia exports to China are mostly for their domestic consumption and are not necessarily for re-exporting on or as part of other goods that China exports to the rest of the world. So actually, we think compared to the likes of CAD, for example, we think that Aussie could outperform.
When it comes to being insulated from those tariffs, I think India would also be one of them. You say that they are going to be the ones who underperform the
we see risks that we could see some slight further drift higher still.
Parsha Sanghvi, good to have you with us. Global markets, foreign exchange, and local market strategies for Asia at BNP Paribas. We have more to come. This is Bloomberg.
CFOs focus on much more than revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has.
We're in an evolving business.
Our first job is to intimately understand and anticipate the consumer's needs.
We've been on a journey to be higher growth, more nimble, and more capital efficient.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this spring, only on Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
All right, let's take a look at some of the key commodities we're watching, tracking at the moment. We've got a slightly softer oil price right now. We did hear from the US EIA saying it sees the global oil surplus hitting 1 million barrels a day next year. That's up from its 800,000 barrel a day surplus prediction just a month ago. Aluminium prices looking softer as well. And we heard from Peter Navarro, senior counselor to President Trump on trade and manufacturing, accusing Australia of, quote, killing the US aluminium market. So that'll be interesting to see how this story unfolds. We've got an iron ore price holding on at $106 a tonne, traded out of Singapore. The materials sector more broadly in Australia right now, a little bit softer, while the ASX itself is flat. Now, I left gold to last for a reason. Looking very strong, just holding on below 2,900 an ounce. It's the Bloomberg question of the day, is how far above 3,000 that's going to go. And when you put it in Aussie dollars, it's even more impressive at about 4,500 an ounce. And Australia's third largest listed ASX gold miner reported record net profit, unsurprisingly, for the first half year. For more on this, let's get to Laurie Conway, Managing Director and CEO of Evolution Mining. Laurie, you must be very pleased with these results. I think you've had a near quadrupling of profit. The dividends almost, well, more than tripling as well. I just wondered, to what degree has a weak Australian dollar really given you a tailwind here?
Yeah, morning, Paul and Sherry. Great to be with you. Yeah, I think when we look at it, when we started the financial year and put guidance out, the Australian dollar gold price was trading just about $1,000 or 25% below where it is today. And the Aussie dollar was certainly a lot stronger than where it is today at 62, 63 cents. So we've seen a lot of tailwinds both in the US dollar and the Australian dollar gold price, which, as you indicated, saw our cash flows were up 420% to 273 million, profit up 110%, and that enabled us to lift our dividend to 7 cents per share, 250% up on our interim dividend 12 months ago. So certainly we're seeing very good markets for gold at the moment, and any gold miner who's not making money today probably shouldn't be in gold.
Yes, so you've lifted the dividend. Do you have any other plans for the funds that you're bringing in at the moment? Are you looking at maybe buybacks or CapEx plans? Can you tell us a little bit about that?
I think we've been pretty consistent around our dividend strategy is targeting paying 50% of our group cash flows out as dividends, and that's what's seen the increase in our interim dividend as we go into the second half of the year. The gold price is trading, $700-800 an ounce higher than what we achieved in the first half. So, on delivering our plan in the second half, that would mean we've got more capacity to pay more dividends in the second half. The balance sheet is in excellent shape. We've gone from gearing of 33% down to below 25%, just on 23% at the halfway mark. So we'll continue to delever to get below 20% by the end of the year. And the real fortunate thing, we've got every one of the assets in our portfolio have got organic growth options that we can invest in over the next few years to either extend our mine life or increase production. We've got an average mine life of 18 years in the portfolio, and every one of those assets have got investment opportunities, and that's where we'll also be putting that spare cash as well.
Laurie, when it comes to the gold price itself, where are you expecting it to go given the tailwinds as it's provided for your business? And what do you think is the China variable here too? We heard that Beijing is allowing some insurance companies to also divest some of their assets into gold and invest in gold. What that means when they're also trying to really veer away from the US dollar with geopolitical tensions rising.
Yeah, look, it's a good question, Sherry. I mean, I can't predict where it's going to go. I mean, as I said, when we put our guidance out in August, the gold price has gone up nearly $1,000 an ounce, 25%. When you look at it, even in the last month or so, it's risen. And it's risen as gold demand, certainly into COMEX in the US, people are buying it as safe haven. And I think as you look at central banks as well buying it, you mentioned about insurance companies being able to put assets into gold. All of that to us says it's very good for a gold mining company, because I think there's more upside than there is downside in the near term on gold. And that's something that's important to us to be delivering to our plan in this environment, because it means we're actually able to bank the benefits of this gold price environment. So in short, I won't continue to go up forever, but I do see the near term seeing gold continue to rise and have some good tailwinds.
And when it comes to your mining expansion, for example, the Mungari mill as well, you're expected to complete that ahead of schedule. How much are you expecting this to affect your operations and also impact on your cash flow?
Yeah, the Mungari project, where we're expanding from 2 million tonnes to 4.2 million tonnes per annum, it'll take Mungari's production up from 130 to 200,000 ounces, at least for the first 5 years post-commissioning, and we'll commission that by the end of June this year. So from next year, it's a perfect time for a project like this, where you're more than adding 50% of your production in place at
You mentioned a minute ago that if you're not making money as a gold miner in this environment, you're doing something wrong. But if we take a look at some of your Canadian assets, they're quality assets, but compared to your Australian ones, they appear to be underperforming.
for trades as well. So without that sort of level of investment and commitment going in post this election, it's going to be pretty difficult for mining if we don't have those three aspects well covered.
Director and CEO of Evolution Mining. We continue to watch automakers here in Japan. The markets have come back from a holiday, and we've just heard from the economy minister Muto now saying that Japan has asked the U.S. to exclude Japanese companies from steel tariffs. Of course, President Trump has announced 25% tariffs on steel and aluminum. We are now seeing Toyota, for example, trading at the lowest levels since December. Mitsubishi Motors also falling almost 3% as we continue to watch different sectors that could be affected by the trade tensions rising globally now. We have more ahead on the Asia trade. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
Do you see a future in which Coinbase is competing with the banks for custody business?
Oh, absolutely. You know, our goal at Coinbase is to promote economic freedom. We welcome competition. We think banks are a critical part of the ecosystem. We actually do a fair amount of lobbying just to make sure their status and ability to engage in crypto activity is clear.
Don't miss Bloomberg Crypto live Tuesdays.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Battery maker CATL has filed its application for a jumbo listing in Hong Kong that could be the city's biggest stock offering in 4 years. Let's go to Hong Kong and our China correspondent Minmin Lo. So Minmin, what are we expecting the demand to look like from this deal?
Well, the company has not disclosed the scale and timeline of this deal, so it might be a bit too early to tell. But CATL is a household name that needs no further introduction. It's been listed in Shenzhen, has a market value of about $150 billion. Its share prices has been down about 5% year to date so far, but it was up 68% last year. It had very good results, earnings up as much as 20%, and is on track to hit a new peak in its annual net income. And this is a company that is the leading producer of these EV batteries, accounting for about a third of global shipping, and its runner-up BYD is accounting for just less than half of that, according to a research firm in Seoul. It supplies to the big automakers like Tesla, Stellantis, among others. But bear in mind, though, it has come under fire from U.S.-China trade tensions. It got listed last month onto the Department of Defense's list of companies with alleged ties to the military, so that while that list doesn't actually carry any explicit sanctions, it could have the psychological impact of discouraging U.S. companies from working with this firm. But given the familiarity that people already have with this company, likely to see a pretty solid demand there.
Meanwhile, bubble tea maker Gooming's about